Hi everyone, thanks for joining us today. I'm Emily and today we're at the Creighton Business School with Dr. John Deskins. And today we're going to be talking about the Federal Reserve and economic recovery. So John, what's on your mind today?
Well, I've been thinking about the Federal Reserve. They're in the news very frequently. And they intervened during this recent economic downturn very aggressively in many ways, but probably most notably by reducing this key interest rate, the federal funds rate, from 5.25% in August in 2007 all the way down to near zero in December 2008.
So why is this important?
Well, this federal funds rate is tied to the prime rate, which is tied to many short-term rates, credit card rates, auto loans, these home equity lines of credit, these types of rates. When the federal funds rate falls, when these other rates fall correspondingly, that makes it cheaper for people and companies to borrow money to spend. So if we see it looks like we're going into an economic downturn, we can cut rates, we can provide a monetary stimulus. People will have an incentive to spend more, and maybe that can soften the blow of an economic recession. Maybe a recession won't be as severe if the Fed attacks the recession, you might say, with monetary policy by cutting interest rates.
So what's the problem with doing that?
Well, the problem is that to get interest rates to fall, the Fed has to put more reserves into the banking system. The Fed has various mechanisms to do this, but ultimately they put more reserves into the banking system. That means a larger money supply overall. That's not a problem when we're in a recession, when there's a lot of slack in the economy. But when the economy starts to recover, additional money can mean, or will mean, higher inflation. So the issue is, as we recover, which it seems like we're starting to recover now, but as we recover, the Fed has to pull that money back out of the economy to make sure that inflation doesn't happen.
Why is that so difficult to accomplish?
Well, one reason it's difficult is because it's a question of timing. It's hard to figure out exactly when to pull the additional money, the additional reserves out of the economy. If we pull the reserves out too quickly, if we raise interest rates too quickly, same thing, those are synonymous, then it could hurt our economic recovery. In our economy, it seems like we're in recovery, but for sure, still very fragile. It's safe to say the recovery is very fragile at this point. So if we move too fast, it could hurt a fragile recovery. If we move too slowly, then that's when we see inflation start to spike, start to become volatile. To make matters worse, monetary policy acts with a lag. If the Fed moves today, that's probably not going to affect the economy for maybe 9 months or maybe even for a year. So the Fed has a hard job anyway, but the Fed has to act in response to what it expects the economy to be doing 9 months from now. Makes the job much more difficult.
And what do you personally expect to happen?
Just really quickly, I'll mention that the Fed has already sent at least some signal that this monetary reversal is on the way. Just the other day, last week, the Fed raised another important interest rate, the discount rate, from 0.5 points to from 0.5% to 0.75%. So that was a little bit of a sign that this is going to be coming in the future. But overall, economists are forecasting this major reversal to begin anywhere between this summer through maybe the middle of next year. Overall, it seems like forecasts center on interest rates beginning to move up around this fall. So maybe October or November we'll see the Fed move to raise rates. But my personal opinion is I would not be at all surprised to see some volatility in inflation once this gets underway. Again, the Fed's job is very hard, so it would be quite difficult to avoid any inflation volatility at all. But overall, I have some confidence in the Fed. I think they are going to be hawkish on inflation, and I don't expect a sustained increase in inflation, even though we might have a few months or even a half a year or even a year with above normal rates of inflation. I don't expect to see that on a sustained basis.
Okay.
And just mention, to refer back to my earlier blog, that is as long as the Fed's independence is maintained. If the Fed's independence isn't maintained, then who knows what kind of mess we could end up in.
All right. Thanks.
Thanks.
Thanks everyone for watching today, and remember, if you have any questions or comments, feel free to visit us on Facebook, stop by our blog, or follow us on Twitter. Thanks for watching.